Chris, yeah, that was a fun event that we did. It was another very cold Winnipeg winter day, just as we're seeing here today. We're hovering around minus 30, so that's a kind of par for the course with what we have this time of year. But since then, we've done a lot of events like that. We've had the opportunity to do a lot of speaking and connect with a lot of farmers all the way across the prairies. And something that's always come up, and that is a bit of a theme, an underlying theme for this whole hour that we're going to be spending together, is just the title of what we're going to discuss. I like to call it Precision Farming for Your Marketing Plan, because it's true. We see so many advances on the technology side. I mean, it's amazing the equipment that's out there, what can be done from your iPhones, from your iPads. It's absolutely fantastic. But the one area that I seem to get feedback on over and over and over again in terms of, we need more, we need to learn more, we need to understand, is on the marketing side, on the hedging side, on managing the risk, how to be more proactive, when to be aggressive, more importantly, when to be cautious. So those are all the things that I've been hearing over and over that really come into play when we start looking at how can we help? What can we do on the marketing side? Because a lot of the work that we're going to be discussing here today, we do with other industries, with other companies. But for various reasons, when it's come to the agricultural industries and the farmers, there's just been a little bit of a lack of opportunities to learn more about awareness. And that's why these type of webinars are so good, because it gives that outlet. So the other big trends that we've seen over the years, of course, as we know, is with the dissolution of the Canadian Wheat Board. When I look out my office window down here at Portage and Main, I can see the building, and it used to be the good old CWB, Canadian Wheat Board logo. Then it changed to CWB, and now we know it's G3 today. And what that's all meant is that with that dissolution, it's really encouraged or sometimes forced people to look at how are they going to market their grain differently. And that's the hole that we've seen that we really want to try and fill in. So the other one, of course, is just the demographic changes that we've seen across the country, but certainly in the farming community, where there are a lot more of the people, the prior generation of farmers who have been working on the field are starting to move on. They're starting to change their approach, and a lot of the younger farmers that we're working with as well, they're starting to pick up some of that, pick up the reins and go with it. And what I hear more and more, and not just from the younger ones, but also from the older ones, because of those two big changes, is let's learn more about marketing. And before we get in, the last note I'll make is that every time I see a study or research report done on hedging and farming, it always blows me away that when I talk to colleagues in the States, and say from the Chicago Board of Trade, I ask them what percentage of farmers down in the States tend to use futures and options as another part of their marketing tool. And the answer always comes back probably around 30-35%. So let's call it a third. When I see those same reports about Canada, and I just read one recently, it was in the neighborhood of about 5 to 10%. So that just means that there's a lot of room for us to move forward in that area. And it doesn't mean we have to follow what the States is doing, but sometimes it just makes sense to look at what some of the the other people are doing and what peers are doing, and follow suit and basically increase the size of our marketing toolbox. So as we begin here, I just want to give a quick overview of what we're going to discuss, a little bit about the firm. I know some of you out there will be aware of us already, the three-person team, and there's some very important reasons why I want to share a little bit about, very quickly, the history about that. Next, we'll move on to the lighter side of risk. And that's sort of the philosophy or theory that we've had and the practice that we've seen over the years about what risk is really all about. Top 5 marketing questions that, especially at the beginning of the year, could be almost like a little bit of a New Year's resolution that you want to ask yourself and seriously consider, because there's some really good points that come up there. It can't go any lower, or what we call our research. We'll move then into our crop hedging program, which really just gives an example of prior years of what some of the hedging strategies we've worked on, because I always hear the feedback I often get to is, the research, the strategies, the ideas are good, but let's see some actual numbers, how this works. We wanted to make sure we included that. And then finally, we'll end off with a little bit more market research and an outlook, because we all want to kind of get a sense of what may or may not happen this year. So as we begin here, the firm, PI Financial, we are one of the largest independent investment and commodity futures advisors in Canada. Pardon me. And that's really important because there really are very few futures advisors across the country. And that's why it's been very challenging for a lot of the farmers to learn more about what's available, what's happening out there, because there just aren't very many people like me that are doing it to share the ideas. Lots of stockbrokers, lots of investment advisors, lots of financial planners, which is all very important. But what's happened over the years is the industry has tended to not encourage and develop a good base of commodity futures advisors to help, especially here in the prairies, with farms and helping them manage their risk and protect their revenue. So that's why, as an independent firm, I think it's really important to have that focus on commodities, because there is a lack of it overall in the industry. And that, again, is where we've seen the need and we've seen the pull from people wanting to learn more about it. The firm itself, 31 years, well, 32 years in existence now. And, that goes a long way, because we've got a good element of history, and we want to make sure that people are comfortable and confident in learning and understanding what is out there. When we look at our three-person team, the three of us are all licensed in commodities and futures, and we're also licensed on the investment side. So this is important because it's not just about managing your risk. It's more the bigger picture of the farm, family, and finances, because whether it's the value of your land, retirement, the managing your expenses, or protecting your crops, it's the bigger picture, and it all comes down to your pocket. So having an understanding and working with people not only on their hedging side, but also on the investment side and the retirement planning, gives a much more rounded service offering, and it really helps kind of get that whole picture of how do we help you manage not just your farm, but also your family and the finances. It all gets wrapped up in one. So there is the three-person team, and so obviously myself and Joseph and Adam, who, as Chris mentioned, was the one that really stepped in last year and gave that presentation here in Winnipeg. And so we've all got a long history in working with commodities, working with farmers. I myself, I have the most gray hair, so I guess by default I'm the most experienced. But I've always had a connection and a history with the commodities and the farm clients. And in fact, what I want to show here is this is actually my first trading card ever when I was on the Winnipeg commodity floor. When we actually would be in the pits when there was an open outcry pit, which was really quite interesting and bygone era now. But that trade happened on August 31st of 1995, and I bought canola at a price of $396.90 a ton. What's really important about that is not so much that that was the price of canola at the time, but the fact that since then we've seen canola drop down to about $250 a ton. We've moved up to about $750, and now we're hovering about $500 at that midway point. So hasn't really gone, from 400 to 500, a whole lot of didn't move much in the 20-year period, but it covered a lot of ground. So that just brings back the idea of, as you very well know, there's a lot of risk and there's a lot of volatility in these markets, and that's what this is all about, is how to manage that, how to capture the big upsides and avoid the big downsides. So the lighter side of risk, I want to use this as a way to, in a bit of a lighter manner, address a really serious topic, which is risk. And I find sometimes that pictures are better than words, so I've come across a series of slides that really emphasize and highlight risk and volatility and the psychology behind trading and making marketing decisions. So I wanted to share this series of slides here with everyone. The first one, and this is probably one of the most interesting ones I've seen over the past 20 years, is here we've got, fellow standing in his tattered clothes, the fireman behind him putting out a blaze, and you've got the manager here under the sign of the risk management department is now open, and the fellow in the tattered, burnt up clothes says, as usual with you people, Jackson, it's too little, too late. And I find that this is very telling because, learning how to manage the markets and be involved in the markets is not necessarily something that, say, you can do it on the weekends when you have a little bit of spare time, or maybe, during the winter time now where we got a little bit of a break. The learning that we're going to be doing in these kinds of sessions and at different conferences and at different producer associations over the winter time is extremely important, but it's something that really needs to be carried over throughout the whole crop marketing year. So, for us, the risk management department never closes. It's something that we work on a very regular basis with clients. It's even when markets are quiet, there's still strategies to be considered. You got to think out to the future. What's going to happen? What does it mean to my own operation? So again, for us, the risk management department can never close. Next one here is you got a fellow here, end of the day, sitting back watching the news, and up pops on the screen is, the following program contains the latest numbers from Wall Street. Viewer discretion is advised. This is important because there is so many newsletters and research reports and analysis that's being done, and by and large, the majority of it you can probably ignore. It's not that it's not important, but there's just so much of it out there, and you can really drive yourself crazy trying to follow and capture everything that goes on out there. And that comes up in conversation occasionally when I'm sitting around with a group of farmers and say, you know what, there's so much to follow, I just don't have the time. And it's true, you don't have the time to follow it all, but the nice part, no, is you don't have to follow it all, because the majority of it you can ignore and you're not going to miss a beat. We'll see later how we like to look at longer term trends and bigger picture things and not worry about that day-to-day minutia with, if you try and follow it, will really drive you crazy. So don't try and follow it all, because you can't and you don't really need to. Next one here is we've all been in a situation like this where, here we see the chart going down and the fellow here says, it would appear, Hopkins, that your gut feeling was only indigestion. And this comes up where, we'll be on the phone with clients and people say, you know what, I got a feeling that I think we're going to see this price goes higher, or markets just don't make sense at these levels. It can't go any lower. And yes, we all build up our intuition over the years based on our experience, but realize that the market is always going to be right. Even when it's wrong, it's right. And sometimes that gut feeling really might just be indigestion. So you don't want to get too locked into a belief or feeling, or you read a couple of reports and you really think that prices should be moving higher. You got to be very humble and objective and just say, look, this is what the market's doing, and those are the numbers that we have to deal with. So bottom line, if you have a feeling, just double check it, make sure it's not just indigestion. Here we have a group of people around the boardroom table, and one of the people, I think the lady here, pipes up, or maybe it's this fellow here, it doesn't matter, and says, what if we don't change at all and something magical just happens? We can all be a little bit hesitant to change and a little bit resistant, and in the marketing side, that can come up on a fairly regular basis. And I think now with so many changes going on, what we have seen is that there have been a lot more people that are starting to learn about it and embrace different marketing tools, having a bigger picture toolbox over and above just, production contracts and basis contracts were very important. But to learn about everything else that's going on out there, including what we're talking about here today, with managing your risk and using futures and options, I think that's important because, if we don't change, no one's going to change for us. So the onus really is on us in everything we do, not just our business world, but our personal world too, we have to make the change if we want to make it happen. So I'm seeing that kind of change develop, which is really positive, but there's always room to do more. So you got to make the change. It's not just going to magically happen. So, I appreciate everyone who is on the call here today. Next slide. Here we got this one fellow, and I like this one. He's all bundled up. He's got a hard hat on. He's got ear protectors on, pillows, knee pads, gloves, the whole bottom, everything. And he's not, he's fully protected. But what this means to me is, you don't want to be trying to avoid every single risk out there, because that's not realistic either. If you don't want any risk, take all your money and stick it in a T-bill. What this really means to me is that there are some risks and some things that you can concern yourself with, that you can do something about, but there's a lot out there that you just plain can't. So don't spend your resources and your time and energy worrying too much about things like, maybe like the weather. You can't do anything about that. Yes, you can adjust your production practices to take that into account, but focus on the risks that you can deal with and don't worry too much about the ones that you can't, because you're never going to avoid everything, and that's just the nature of business. So, people sometimes get the view that they have to focus on eliminating all the risks in their business, and that's not true either. We will want to take the risks that are going to give us the appropriate potential upside, but not worry too much about eliminating all the risks out there, because you could insure yourself away and you don't have any risks, but then you're probably not going to get much return. So those are a series of slides that kind of give our view, maybe a bit of a philosophy, maybe a little bit of a humor on shedding light onto a topic that seems kind of mysterious and maybe doesn't get enough airtime, so to speak. But Risk is really just about what is the risk that the way I look at risk is it's all about you not meeting your objectives. It's not so much what markets are doing, what your neighbor's doing. It's all about bringing it back to you personally, and what does that mean? So that brings us into the next section here. We want to look at some of the top 5 marketing questions, and what we'll go through here. It's actually this series of questions comes from 2 reports that were done both by the government of Saskatchewan and the province of Manitoba as well. And there were a couple of reports that is basically a self-analysis or a self-inventory, if you will, of a whole bunch of questions as it relates to farm and farm businesses. And I just wanted to get the exact quote from where these are from, because I really do urge you. I mean, we can forward the links to you as well. But one of them was the Gaining Ground report done by the government of Manitoba, and the other one from the government of Saskatchewan was Taking Stock. And they're really both farm business development initiatives that give you a list of questions from marketing, from production, from human resources to go through and self-assess your own business. What are you doing right? What aren't you doing right? Where can you improve? So excellent to studies, and that were done under the Growing Forward program. So have a look or contact us and we can forward them to you. So what we've picked out here are the top 5 marketing questions. And the first one is, do you set marketing goals that can be measured and have a written marketing plan? And I know from experience that there are a lot of people that do have something in place, and it might be actually written down, and a lot will say, I like to have a certain amount of my production priced coming into the springtime. Maybe by summertime, I'm more comfortable increasing that to maybe from 25% maybe to maybe 50% of my production, and then as fall time comes on, I like to have 2/3 to 3/4, and then by harvest, I've got what I want priced, and that can be at least some type of measure. There are others that I know from speaking with that don't have anything, and we all do better by writing something down. And it doesn't have to be elaborate, it doesn't have to be complicated. In fact, the more simple, the better. But having something that you can measure, you'll tend to treasure. So have it written down, have a marketing plan that's at least as a guideline early in the growing season or early in the crop year that you can use, because the next question is, do you monitor and revise that marketing goal and plan throughout the year? And that's just as important as having it written down, because very often after we put down a plan in place, 5 minutes later, it's already outdated. But that's natural. Markets change, things change all the time. But as long as we can encourage people to have that type of process in place, it gives us more flexibility. And one thing that we do is we do like to work with clients to help track their actual production levels, what's in storage, what's being hedged, so that they know too at the end of the day, what's my true exposure? This past year was a good example of that. We started off the year where there was concerns of frost, and then we had drought, and the price of canola started moving up and up and up to 500, 510, 520 a ton. And that for us was a very good opportunity to look at some more aggressive pricing processes, because the gift we were given, and canola got up there and it didn't really stay up there. But regularly monitoring and revising where you're at in the marketing process allows you to take advantage of those moves and those gifts that when they're given to you. So put it in place, but then make sure that it's monitored and it's a working document throughout the year. Next one is whether or not you have the interest and skills to make good marketing decisions. And very often I'll hear people, and it's not just in the farming world, but any business owner says, we're really good at making our product, but I just find that our marketing and our sales and our managing of the risk is not quite as strong as it can be. And that's fine. And some people have taken it on their own to really learn and develop that for themselves, which is great. But if you can't do it, make sure that you can work with someone, connect with someone. There's a lot of outlets and resources available, from government resources to industry consultants to individuals like ourselves that can help in that process. So make that self-assessment. Are you any good at it? Do you have any interest in it? Do you want to get good at it? And if not, make sure that you at least have that component in your business. Fourth one is, do you understand options and futures and hedging strategies? And a lot of people have heard about options. A lot of people have maybe used them a little bit. but it's to truly understand that. And again, a lot of resources that are out there, the commodity exchanges like the Chicago Mercantile Exchange, ICE Futures Canada are really good resources for that. But no one's going to become an expert in it unless it's their area of focus. But at least if you can start to understand them and get comfortable with it, then you're going to be much more confident to actually use them in your own operation. So learning and going on events like this and presentations that are done in conferences across the country, great outlets to do so. Final one is having an overall risk management strategy for your marketing. And what we do with the futures and options is just one piece of that overall puzzle, right? You have to have a really good sense of what's going on the local level. And I mean, the farmers we work with have a much better understanding of that than we do because they're there on the ground floor. But that's one part of it. And sometimes you might have really, really good basis levels, but the outright price isn't so good. So you might want to look at considering basis contracts, but not locking in the outright price. Other times your local overall price is fantastic, but the basis level isn't so good. Sometimes you don't want to lock in production because of the potential delivery risk associated with that. So you shy away from it, but there's other tools that you can use. So it's an overall picture, and it's really about just trying to increase and improve your revenue. So those are the top 5 questions that you really want to ask yourself. And here is the source of those two pieces of work that were done by the 2 governments. And again, I encourage everyone to have a look at them. They really are good. And there's a whole series of questions in there that any business owner, I mean, we looked at it, we just went through the questions, and they're very good to make you think about your business. So we'll move on now a little bit to the research side of our talk here, and it's what we title "It Can't Go Any Lower," because I don't know how many times I've heard over the years that, you know what, it can't go any lower. The stock that I bought can't go any lower. The fundamentals are such. The sales are going through the roof. Or, as we know, unfortunately, in the last couple of years in the grain markets, we've been drifting lower and lower and lower, and too many times you hear, well, it can't go any lower, you know. Look what's happening in China. Look what's happening in Brazil. The weather, the this, the that. So it can and it will go lower. Markets will do what they're going to do. They're going to surprise you on the upside and they're going to surprise you on the downside. So to address this kind of thing, we try not to get too fancy in what we do. You know, there's a lot of research out there, and you can go on the internet and you can find so much on stochastics and RSI and moving averages and all these different technical indicators. And most of them I find don't really work. What I find has worked over the years is keeping it fairly straightforward and simple, and that's why we like to look at charts. Looking at pictures is how we spend a lot of our time. And you look at up here on the screen is an example of feeder cattle. And you know, it's very easy for me to draw these lines on the chart after the fact, but the bigger issue is let's just have a look at what bigger long-term trends are going to do. So when we're tracking these trends, we don't know when it gets to this point here, if it starts to change trend, that it's necessarily going to go lower or not. But once it starts drifting lower, we have a fairly good comfort level and say, you know what, this trend has changed. So for a lot of the producers on the cattle side, yeah, you can start look at marketing decisions. Should you be pricing some? Should you be looking at options to protect it? And once these big longer term trends come into play, they tend to go on for a long period of time. So longer term trend analysis we find is a really good way to get those bigger picture marketing decisions. You know, we're not trying to get every last nickel or dime out of the price of your wheat, but we really want to try and capture those 50 cents, 25 cents, 75 cents, and dollars so that we can help manage the revenue. But markets, of course, they go down and they can also go up. And here's an example of the US dollar going back quite, this one's a little bit of a longer term chart, but the whole idea of this is looking at these bigger picture changes. And when the Canadian dollar was hovering around par, that was 95 cents was starting to be an area for us that was an important change in direction. And in the past couple of years, we really haven't hedged the Canadian dollar at all for the exporters because it's been going straight down and it's been very favorable to them. There will come a time, and I don't think it's going to be this year, but you never know, but there'll come a time when the Canadian dollar will start moving higher again. And we want to be able to capture and be aware of those big trend changes by taking note and being aware of what the big market trends are going to do. But right now, the US dollar index is still very much making its way higher. And this is a good example of a longer term trend that's taken a little bit of a pause in the last several months, but may very well continue higher. So markets go up, markets go down, but of course we all know that markets can go sideways. And in fact, the majority of the time, markets do nothing. They go sideways and they can stay sideways for quite a long period of time. And here's an example of canola. And really, since the summer, it's been very much a sideways market for old crop. New crop, a little bit different. It's been stronger, but this has driven some of our marketing decisions as well. Because it's been going very much sideways, there hasn't been a big push or urge or concern to look at protecting a lot of the downside. If markets continue going higher, then that's an easy decision. We kind of get out of our own way and benefit from the price increase. But if they start moving lower, that's where we're prepared to act. So looking at trends is a lot of the research that we do, and in most cases, it doesn't have to get a lot more complicated than that. We like to look at pictures, and you should be able to put a chart at the other end of the room and stand back and get a good sense of where it's going. So how do we actually use some of this information, especially when it comes to the charts? Well, as part of our overall crop hedging program, we do like to incorporate our pricing decisions by basing it on what the charts are doing, what the markets are doing. Now, very often, you want to have that flexibility. Just as those markets are going to change on a very regular basis, your hedging programs, your marketing decisions need to adjust on a regular basis as well. It's all about increasing the marketing returns, and we like to use options. And I know some of you will be very familiar with options, some of you won't be, but I think the best way to look at options is essentially like insurance. Just as you buy insurance on your equipment, on your buildings, you can have crop insurance. You can also essentially get insurance on the price of your grain. And we'll see in a moment why options for us is probably one of the most beneficial marketing tools that's available. But for the time being, we like to be able to adjust as the markets change. So we've got a series of strategies that are used depending on if A happens, if B, if C happens. So as the markets change, you want to make sure that you can adjust your marketing strategy as well. If you get a big move higher, you want to be able to capture that. If it starts to really move lower, you want to make sure you protect that. So adjusting as the markets change is key, and being flexible. The whole premise is really to balance your production and your storage levels, right? You've got a certain amount of production that's in the fields, sitting in the seed bags right now, or that's going to be stored or stored from last year. So balancing all of those factors is really key, and that's where the marketing tools that we'll use can have that kind of extra advantage. And then finally, again, as I've said a couple of times already, it's really about just enhancing your sales and your marketing activities, capturing those upsides when they're available, and really trying to avoid the downsides. So it's a systematic process. We've got certain points along based on what prices are doing, what we're going to do, when we're going to do them, and how we're going to do them. Always subject to change, of course, because that's the nature of the markets. But just knowing ahead of time what you want to do and when and at what price makes this whole process of hedging your crop a lot easier. So the crop program, it stands for Commodity Revenue Option Protection. So what that means is we're really incorporating options to help protect your commodity revenue prices. And over the years, I've talked to a lot of producers about why they hedge or why they don't. And what seems to come up all the time is, what gives them the hesitancy, or why they're concerned, or why they're a little bit shy about looking at some of these marketing tools that are out there. And a lot of them come down to, I think the best way to put it is there's always a concern, rightly so, about you don't know how much production you're going to have. And that's fair, because right now it's not even in the ground, let alone being pulled out of the ground. So there's always that concern about, I don't know what my production is going to be, so I don't want to have too much delivery risk, and I don't want to commit too much on the production side. Production contracts, as we know, do essentially require you to lock in the amount of production as well. But that's the biggest concern that caused people not to look at hedging. Consider back this year again when I talked about canola after the drought, when it went up to about 5.10, 5.20. A lot of people did not want to hedge any of their pricing. Again, makes sense because they didn't know what they were going to have. But using insurance, or basically downside protection with options, you eliminate that because there is no production commitment and no delivery risk associated with using the exchange traded options. That's one of the biggest advantages that addresses the concerns that producers have had over the years about why they don't want to use or why they don't want to lock in their prices. The next one that's related to that is, when you lock in a price, you are doing exactly that. You're locking in a price. You don't have any downside, but you don't have any upside as well. And when you're using options, all you're doing is you're setting a floor price. Essentially, you got the bottom side protected. So you get the downside protection need, but you get the upside that you want. You always want to be able to tell your neighbor, hey, I got a much greater price on my canola than than I thought I was going to get. And sometimes it makes sense to just lock in prices and do the production contract and get a certain base of that covered. But too many times people don't want to hedge because it's too high and it's going higher. And on the flip side, if it's already low, it can't go any lower, so they don't want to hedge either. So you don't want to hedge because it's too high and it's going higher, and you don't want to hedge because it's already so low and it can't go any lower. So you're never going to hedge. And that idea, it takes a lot of the emotion out of it by looking at a program that just kind of gives you a base floor price, but you still have all the upside of the price increase. So that was another big reason why over the years people have said they don't hedge, is because they don't want to just lock in a price. And then the third and final reason that has come up over and over is the capital requirements and the margins and the margin calls. And everybody here knows the story about their friend's brother's uncle who used options or futures and they blew up, and all of a sudden, hedging stuff doesn't work, so they just shy away from it. Well, that's not so much the point, it's how they're being used. And using futures does have that element of margin calls associated with them, and that's often kept people away from properly considering some of these marketing tools that are out there. So when you're looking at options, there's minimal capital and there's no margin calls that are associated with them. It's kind of like your insurance. Once you pay your premium to insure your truck or whatever it might be, you typically don't have any more any more capital that has to get put up on it. So think of insurance and think of options as truly your best friend when it comes to marketing, because there is no production risk. You don't just lock in the upside. You have the downside you need, but you get the upside that you want, and there are none of those margin calls that have often scared people away. So that's why we tend to use options, because it's addressed the main points over the years about why, and not just farm businesses, but even regular businesses don't hedge their risk, be it currency or the input costs that they are faced with. So this addresses that, and it tries to make the whole process a little bit more straightforward and easy. So let's now get into an example of some of this. And this here is something that comes from work that we did in 2014. And we're going to look at canola using put options. And put options are really just downside protection, insurance against the downside of canola prices. And we're using 2014 for a couple of reasons. One, the year is fully come and gone, so we like to audit the results that we do with clients every year. So it gives us a sense of what worked, what didn't work. And so we got some complete numbers on that. We're basically done 2015 as well, although there's still a lot of people that do have some in the bin, so it's still sort of a work in process. The other reason why we like to look at 2014 is because it's an excellent year to show why hedging works, because prices, unfortunately, if we recall, kind of just went straight down. So we're going to look at canola, and we're going to go through some charts here. And this was a chart of canola December 2013. So we weren't even into 2014 yet. And the market, and if you recall from the charts we looked at before about markets going sideways, and canola was really pretty much going sideways for the past, at this point, for the past 6 months. 500 to 540 was pretty much the range. It had dropped a little bit below 500, came back up, and then it started to go below 500 again. And at the time, we wrote a piece called the Canola 500, kind of in reference to the Daytona 500, where, as we know, in that race, the cars just go round and round and round the track. Same thing with canola, just kept going round and round and round 500 mark, but never really did anything until it started to break out lower again at the end of the year. So what we looked at doing is buying some put protection, essentially insurance. So here, this was going out to November of 2014, so almost a year out, and we were looking at the new crop. So at that point in time, we could buy some protection at $4.90 for about $30 a ton. That $30 is essentially the premium, just like insurance. So we had a little bit of protection in place, and typically when we make these decisions, we're only going to do, a certain amount of potential production. We don't like to hedge, the entire amount at one price at one time with one strategy. That doesn't make sense either. We like to diversify our hedges and kind of hedge your hedges, so to speak. So it may have been 10% of production, may have been 25, may have been 30. It all depended on the individual farmer, but that's what we did. Bought a little bit of put protection. Move the charts forward, and in fact, yeah, canola did drop a fair bit down to about 430, and then it bounced its way back higher, and it came back to that 500 marker again. And this is where the research comes in. We don't know why exactly it broke down and then it came back up, but for whatever reason, 500 was a very important level. It got up there, but just couldn't push through again. And you're never gonna know why everything happens, because again, you'll drive yourself crazy trying to figure out every little point. But we could at least look at this chart and say, okay, 500 bucks. It got here again. Let's see if it stays up. It pushed up. It didn't really break through. So we decided again to add another round of protection. And again, might have been on 10, 20, 30% of production, somewhere in that range. So we bought some 465 puts at 22 bucks a ton. Fast forward a little bit, market's continuing to go sideways, but most importantly, just wasn't breaking above that $500 level, which was very, very key. So we made the decision again, let's add a little bit more protection. This time at 480, and the premium associated with it was about $27, $28 a ton. Now, we were still fairly early in the year, and we're only at about the end of May. But this is where the options give us that sense of confidence, because remember, we're not locking in any prices, we're not committing any production to this. All that we're doing is simply buying insurance on the downside. And because all of these options are traded on the exchanges and you can buy and sell them at any time, you can also get rid of these things too. So if instead canola started moving higher and higher above 500 instead of going lower, we might have very well turned around and said, you know what, we don't need this protection. There's no fire. The market's going up, so let's get rid of this, and we might be able to recapture, I don't know, a third, a half, maybe a quarter of the premium, whatever it might be. But it's a nice position to be in, knowing that you can essentially offload the insurance and get rid of it if you decide that you don't need it. So that's another reason why these exchange traded options are we like to call them a farmer's best friend, because the amount of flexibility. You're not locked into them. You can buy and sell them, and it just gives you much more decision-making power. So let's just fast forward the charts, and going pretty much into the end of the year, canola just kept going lower and lower and lower. So in hindsight, yeah, obviously we were very happy with the decisions that were made. Prices drifted lower and lower and lower. But that's kind of the whole idea of managing risk. You don't know ahead of time. You can't say to yourself, well, you know what, I'm not going to buy insurance on my trucks this year because I don't think they're going to break down. I'm not going to buy insurance on my building this year because there's not going to be any fire. Not that different from the markets. You don't know ahead of time if markets are going to continue moving higher or lower. So you like to have a fairly disciplined process when you're dealing with all these price fluctuations, knowing, of course, that if you want, you can move out of these options and sell them off. So there's the example of 2014. It was a very good year to have hedged because prices tend to just drift lower and lower and lower. So let's do a quick recap of that. And a bit of a summary here. Again, this is the futures price at 406. If we go back to the chart, that's where the November futures contract for 2014 ended off, is about 406. These here, this first row is the protection levels that were purchased, 490, 465, 480. The second column here is the futures price. Again, that's all the same at the 406 level. And the premium amounts that were spent. Don't forget, again, we did this process 3 times, so we're three different levels. And when you net that all out, these were the average gains per ton or the benefit of those different contracts. So, 54, 37, and 48 a ton. Average those all out, and it basically came out to about a $46 a ton gain over what the futures price did. So if you add that back to what the cash, that's basically the cash market here too. This 406 is what the cash market would have been at. Add your 46 back, the net gain from those options, and you came back to about 450 a ton. So that added about just over 10% gain to the revenues on it. And this also makes me think of that whole idea we've seen in the past, and I've seen a lot of good presentations on it where people will talk about that 5% solution. If you can increase, do something better by 5%, improve your efficiency on your production 5%. If you can, reduce your cost by 5%, it all adds up. The nice thing about when you're trying to improve your revenues are 100 cent dollars, right? And so if you can improve your revenues by 5 or 10%, that can have a dramatic impact on your net bottom line, what you put in your pocket. That can increase your net profit margins 10, 20, 30, 40% sometimes. So focusing on the revenue side of it can have a big impact on your net bottom line. Doesn't mean you don't focus on expenses, but it can also be a very good way to really try and improve the overall operations by focusing on how you can increase your revenue. So just a very quick summary of the other crops. Canola added about 46 a ton. Wheat, another very weak year in 2014. It added about 82 cents a bushel. Soybeans, another about $1 a bushel. So all combined, the regular hedging in that year added about an extra 15% return on the revenue of wheat and about 10% increase on canola and soybeans. 2015, we've gone through most of the numbers, much more challenging year to actually implement hedging strategies. And, I think back looking at the numbers we've audited so far, and I think soybeans might have added about a nickel. So really didn't do much. Wheat was a bit of a benefit because we had some big spikes in wheat and we were able to take advantage of that. And that probably added about 7, 8, 9, 10%, maybe 13% to the overall revenue. And when I think of canola, most of the hedging was a little bit more challenging this year, and I think it might have cost 2 or 3%. So overall, this past year was a little more challenging for hedging, but again, you don't know at the beginning of the year what it's going to bring, so you still want to go down that process of having positions in place and being ready to do something. So that gives a bit of a summary of the past, but let's focus on the future here. We all want to have a look at what's happening now. Now, this chart is just a couple weeks old, but it's looking at new crop. What's going to happen in about 11 months from now for the new crop of canola? And this new crop canola has been edging higher and higher and higher. And it's continuing to move its way up. And we really haven't done much on the hedging side for 2016 for canola because there hasn't been much need to. It's been going up. So in these situations, we like to get out of our own way. If there's no fire, let's not get too concerned about it. But let's keep a close eye on it, because if it starts breaking down and going lower again, we might change that decision. But for now, it's moving up. The Canadian dollar is certainly helping the price of all of our commodities here, but canola, you see it quite directly. So canola, the trend is moving higher for the time being, and we'll let the trend carry on in that direction. If it changes course, then we're going to be ready to change as well. Wheat, a little bit of a different story. As you can see, the wheat chart is right at the end, at the very bottom of the chart, and it's kind of still sitting there. Wheat's been drifting lower for a while now. The trends have been just weak, and the situation is a little bit different here across our prairies because the Canadian dollar and some of the really nice strong basis levels that we're seeing. But overall, if this trend of, and this here is Minneapolis wheat that I've used, if that continues lower and lower and lower, we can't count on the Canadian dollar to keep the price of all of our grains steady throughout the year. So we want to be very careful of this. It's been kind of going a little bit more sideways lately. But we do want to be ready if this trend continues, because nothing's stopping wheat going down to $5 US. I mean, another 50 cents from here, a 10% move of wheat in wheat can happen all the time. We'll move on to the Canadian dollar. I think this chart is pretty much self-explanatory, going lower and lower and lower. And the flip side to this, though, is if you've got some big expenses, if you're buying equipment or any iron south of the border, then that is obviously going to cost you a lot more. So great for our Canadian farm revenues, but if you've got expenses that you pay in the U.S., you might want to think about some hedging strategies on that, because you can hedge the Canadian dollar just as well as you can hedge canola or wheat or soybeans. Diesel prices, cost of fuel, this comes up a lot. And yes, there are ways that I've answered over the years where you can hedge the price of fuel, price of diesel. Now, the price of a diesel futures contract is often quite different from the price that you're going to pay at your local at the local dealer. But diesel prices and all grain price or oil price are still heading lower, so not much concern yet. But things will change. We don't know when, but we want to be prepared for it. I want to just focus on fertilizer a bit because we've often had questions about fertilizer, and it's not something that we can hedge because prices there's just no futures contract. So we've looked at what has been a market that we can track to give our clients a bit of a guidance on what prices are going to do. So while we can't really track futures prices on potash, there are prices out there that do have a connection to it. Obviously, big producers like Potash and Mosaic Corp have a really strong correlation with fertilizer prices. So we looked at over a 20-year study the connection between Potash and Mosaic Corp and fertilizer, and the connection was quite strong. It was about 90%. So that just means that when one goes down, the chances are, and the other market will probably drop about 90% worth of that difference as well. So it's not just the price drop that was dramatic, but also the lead time. These two stocks, Potash and Mosaic Corp, tended to lead cash fertilizer prices by roughly about 3 to 6 months. So that's kind of like looking out your window into the future for a 6-month period. History is just a guide; it's not a guarantee. But when people ask what should we do about fertilizer prices, and I hear a lot of people sometimes complaining, every year I buy my fertilizer, store it because they say it's going to go up and up and up in the spring, and it never does. So what should I do this year? We don't know for sure, but this gives a little bit of guidance. And these two stocks have continued to drift lower. So, there's probably not a big rush. If you can store fertilizer, great. But, I don't think there's any big rush to jump onto the sales that are being marketed right now. There's not much indication that we are going to move higher. We did the same research and we started thinking about other things that could affect farm pricing. So we started looking at a bigger picture, and what we did is a study between US farm receipts for livestock and grain producers and connected that with some of the very large agribusiness stocks out there. Deere, Monsanto, Kubota, Bunge, Archer Daniel Midlands, you name it, a lot of the big agribusiness companies. And what was interesting about that is, once again, the connection between those stock price of all those agriculture and farm related companies and the level of farm receipts had a very high connection, a correlation of, again, about 90%. And anytime I see anything about 70, 75, I get excited. But 90% was a really strong connection. But it kind of makes sense. I mean, if you're selling to farms and farm equipment across the agricultural industry, you're going to be affected by what farm receipts are doing too. But what was more important is the lead time. The stocks tended to lead actual farm receipts by anywhere between about a year to 2 years. So that's a really long-term window that you can look through to get a sense of what's happening out there. And this is what this basket of all these stocks look like, Agrium and Potash and Deere and Bunge, and it's continued to drift lower and lower again. So what this is telling us is, it's probably going to be another couple of tough years on the farming side, right? I mean, prices are drifting lower, demand seems to be dropping. There's issues going on in China, Europe. So given what the research is telling us, given what the markets are currently doing, I think it is going to be another couple of tough years out there. And that makes using options and futures to hedge all that more important. Understanding how these markets work, having a bigger basket of tools in your toolbox is key, so you can take advantage of the price moves when they go higher, so you can be prepared to manage that risk when it goes lower. And the trends is what's making this difference for us, and we follow them, and then we want to be able to be ready to react. So, I'll give, to finish off here, a couple of good sites that people can go to. We're always asked, what are some good sites I can go to learn about more and get more pricing? This pdqinfo.ca that I have up here is a project put together by the Alberta Wheat Commission, and it's an excellent one because it gives the price for 7 different commodities across 9 zones across the prairies, and they're all cash prices. They have some deferred basis contract or deferred basis prices. But what I really like about it is that when I'm talking to clients, I can get a pretty good sense of what they're seeing in their local levels just by referring to these markets. So have a look at pdqinfo.ca, and it gives some excellent pricing and charts and history on different commodities throughout your area. Another really good one for people who want to learn more about options and quotes and futures prices and get some charts is the CME Group. That's just the Chicago Mercantile Exchange. They're the largest futures exchange, and basically the majority of the contracts that we trade, be it cattle or hogs or wheat or soybeans, soybean oil, they're all traded on the Chicago Exchange. ICE Futures Canada is another one, but CMEgroup.com is a very good place if you just want to get some pricing, and this goes straight to the source because the CME Group is where these markets trade. And then the last one is a very good source for, again, charts and looking at longer term trends and getting some option pricing so you can figure some of the stuff out by yourself. Just barchart.com. Really great source. You can pull it up on your phone. They might even have an app. I'm sure they do. But a couple of really good sources. So have a look at those. Those will give you a little bit more information as well. Get a little bit more comfortable with what's out there. And we are more than happy to make available to people our we do a radio spot that goes across the about 30 different radio stations across the prairies, across the Golden West network, and they're usually only about 2-minute spots, but they typically are issues and topics that come up from talking to our farm clients throughout the week. And if they're having questions on it, we like to put it into a radio piece and try and address it, so it might be something that you find helpful as well. If you have interest in it, connect with us. We're more than happy to share that. It's a great way to begin the learning. And given the time, we're all available to be reached either by email or by phone. If you have any questions, I'm more than happy to answer any of them now.
Thanks very much, David. I think I would agree with the word mysterious, indeed. My head always spins when I hear about and discuss this stuff. We have a fellow at work here who knows the business, and yeah, I have a lot of questions for him. So thank you for clearing some of that up. We certainly do have questions. Kent asks a very valid question to start us off. Before trading, how much money do you advise a client to have in place?
Good question. That all depends. And, I think back over the last couple of days, we've had quite a few people interested in it. That question always comes up, and it really comes down to the size of the operation and whether it's, 2,000, 3,000, 4, 5, 6,000 acres that you run. I'm thinking that the majority of them, to be able to do what they want to do to get started, I mean, even a 20,000, 25,000 amount deposit gives you a lot of flexibility to begin the process. It's not a very capital intensive process. So I would say that's probably a good range to think about. If you're a much larger farming operation, then of course it's just going to go up higher. But for a lot of the clients that will work within that $3,000, $4,000, $5,000 or 3,000, 4,000, 5,000 acre range, then that's a good starting amount to at least begin the process and start learning by doing.
Thanks, David. Eric wrote in. I'm pretty sure his question came in while you were talking about the canola puts,
Okay.
and he asks, how did you know the option was cheap enough to take?
That is a very good question, and a lot of that depends on, I mean, we don't know if it's going to be cheap or not till after the fact sometimes. Yes, options can be very expensive if there's a lot of market volatility and a lot of concern, like during the drought in canola, or the drought that affected a lot of canola prices this year, in July of this year, canola options got a lot more expensive, okay? And the options are going to increase or decrease in their cheapness or expensiveness. It's kind of like insurance, an 18-year-old kid driving a red sports car is going to have a lot higher insurance premium than me driving my truck. So some of it is just the risk and the volatility that's out there. So you want to be aware of that, just how expensive are these things. And if there's a lot of uncertainty, if there's a lot of weather risks, then yes, those are going to be more pricey. You don't know if, it's only after the fact that you're going to know if it's going to be a good investment. And that's why sometimes you can't necessarily make the decision, well, I don't want to buy this insurance because it's pricey. There are other strategies you can do to alleviate the risk, but a lot of it, how did we know it was, the option was cheap? We didn't know it was cheap, but we just had a good feel for the timing of it because of what the trends were doing. They were drifting lower and lower and lower, so it made sense to be buying insurance because we could see the trend drifting lower. So that was the bigger overriding decision: is do we want the protection or not? And as long as it's not ridiculously expensive, then we will look at doing it. So I hope that answers the question in a roundabout way. It was based on really what the chart was doing, what the trends were doing, that made us decide that this was a good price.
Fantastic. Margaret has it's a bit longer. You made reference to how the depreciating Canada-US exchange rate can impact farmers. Do farmers also use currency ETFs options as a rule? Do you recommend they do?
As a rule, no. I tend to see not a lot of them use it. Do we recommend it? We did a lot more currency hedging when the Canadian dollar was above par and going higher. Now that it's dropped lower, there's been no reason to recommend it. The only time that it can make, well, I shouldn't say the only, sometimes that it can make very good sense is the situation where you have about 400,000 worth of equipment you want to buy from the States in 6 months. Okay, if the Canadian dollar drops another nickel between now and then all of a sudden that's going to cost you an extra $25,000-$30,000 more. So there can be good reason to hedge your expenses if they are in US dollars. That right now, that would probably be the main reason for looking at that, because we haven't done much lately. As it's gone lower, it's been a big benefit to us. But if you've got US expenses or big investments of equipment you want to make, consider hedging that currency, because if it goes if it goes lower, it's going to cost you more, period.
And our final question comes from Michael. How can we deal with the situation now of lower futures but good basis?
What was the last part? How can we deal with the situation? What, sorry?
Now of lower futures but good basis.
That's a good one, because that comes up very, very often. If you're getting a very strong basis level, then that's where it's nice to have the independent decisions where you can lock in your basis but not have to worry about your outright futures price. Okay, so if the basis is very strong right now, it can make sense to you can always, if prices go higher and higher and higher, then maybe you just lock in that full price later. You can always use options to do that. If it goes lower, you can use the options to protect against that downside. So a lot of the times the decision to price is based on those two inputs. What's my basis level? What's the futures price doing? So that happens all the time. So if basis is good, protect that, and then you can kind of free up your mind, or you free up your mental resources to consider how you want to hedge the outright futures price and do them as independent decisions. I hope that addresses the situation, because that's what we do. What's the basis? What's the futures? Does it make sense to hedge both or none, or one and not the other?
So on that note, David, if you have any final words of wisdom or advice, please pass them along.
I do, because we just did a series with the Alberta canola producers in Red Deer, and it was a whole session on hedging and risk management. And we got a lot of really good feedback from the event afterwards. And what I'll just read out is, a good portion of them, probably about 90%, and this comes back to the numbers before, about 10% of producers haven't used options or futures. And After the session, there was a large number, about 60%, that had said, yes, we do want to learn how to do it. We need to do it. We need to learn how to do marketing better. We need a better understanding of marketing. But what I find is it's always, we learn by doing, and we're all the same. Where the more we can do stuff, get our hands dirty, get in there and understand it, the better. So do what you have to do to get comfortable, to learn about it. Um, you know, Online there's resources. We have a lot of resources. The exchange have a tremendous amount of resources. Your producer associations might have it. So I'll finish off with a couple of quotes. One is by Benjamin Franklin, who says, by failing to prepare, you're preparing to fail. Or as we like to say, manage your risks before they manage you. So do what you have to get comfortable with it. Put these tools in your marketing toolbox. And I've seen it over and over where people say to me, David, this hedging isn't really all that challenging. I said, no, it isn't, but you took the time to learn about it and understand it, and now it's just part of your overall business operation. So do what you can to prepare yourself and just learn about it, because whether markets go up or down, this is something that should be regular part of your decision making, on a weekly, monthly, quarterly basis. So do what you can to educate yourself and learn about it, and you've got a lot of resources out there. And thank you very much. I appreciate this. I always like doing these sessions, and we're always open for questions afterwards. You're more than welcome to contact us if needed. Thank you.